All right, welcome back to The Explainer. Today, we're diving into the complex post-submission phase of medical billing, claim adjudication and payment posting. If you've been following along, just getting that claim out the door, yeah, that's really only half the battle. We're going to unpack exactly what happens behind the scenes, how to actually decode the remittance data you get back, and essentially how to bulletproof your practice's revenue cycle. Let's get right into it. Here is our roadmap for today. We are covering the payer claim adjudication process, deciphering EOBs versus ERAs, analyzing line item payments, the actual mechanics of payment posting, and finally, resolving discrepancies in billing.
Okay, Section 1, the payer claim adjudication process, evaluating the submitted claim.
So, what exactly happens when a claim lands? Well, adjudication is basically a strict, step-by-step evaluation. Think of it like a highly sophisticated software system acting as a gatekeeper. First, it examines the claim to make sure everything matches the patient's specific insurance plan. Then, it uses the physician's NPI to pull up your exact payer contract. It's a rigid comparison. Billed codes go head-to-head with contract terms, and based on that matchup, the payer decides right then and there: pay, reduce, or outright deny. Now here's a little twist. Even if your claim is perfectly clean, literally instantly approved, you still might not get paid right away. Why? Because payers, like Medicare for example, are legally required to meet what's called a payment floor. This is an actual congressionally mandated holding period. It means they won't release those funds until the clock runs out, no matter how fast the computer processed it. Keeping this in mind is absolutely crucial when you're projecting your clinic's cash flow.
Moving on to Section 2, deciphering EOBs versus ERAs, reading the payer's decision.
Okay, you hear these acronyms thrown around all the time, and honestly, they're often used interchangeably when they absolutely shouldn't be. An explanation of benefits, or EOB, is for the patient. It's written in plain language so they can understand what was billed, the network discounts, and what they actually owe. The electronic remittance advice, the ERA, that one is for you, the provider. It's the heavy-duty back-end data that your billing software needs to actually process the payment and handle all that complex coordination of benefits. So arguably, the most crucial piece of data on these documents is the write-off. This is basically money left on the table, and you are contractually obligated to cancel that portion of the bill. Say your standard fee is way higher than your negotiated insurance rate. You can't just turn around and bill the patient for the difference. No way. That difference is the write-off, and you must legally and ethically wipe it completely off the ledger. That brings us to Section 3, analyzing line item payments, the math behind the remittance. Let's actually break down the math on this. Imagine you bill $200, but your contract only allows $150. Boom. That creates an immediate $50 contractual write-off. Now, out of that allowed $150, let's say the patient has a $20 copay. The payer is going to subtract that $20, leaving a net payout to the provider of $130. It sounds simple, right? But your job is to verify that every single line item matches your specific payer contract down to the absolute penny. Of course, it's not always just basic math. Reimbursement amounts are heavily influenced by relative value units, or RVUs, which assign a specific monetary weight to different codes. Because of how that works, you'll generally want to prioritize and list your highest paying procedures first on the claim. And you really have to watch out for negotiated carve-outs. These are special clauses that bypass the automatic processing and require manual handling by the payer. And as you might guess, manual handling usually means your payment gets delayed. All right, Section 4, mechanics of payment posting, entering data into the system. So in practice, the payment poster in your office has to systematically reconcile all these incoming funds, whether it's a massive bulk electronic funds transfer or just a traditional paper check. They have to confirm the amount matches the expected contract rate perfectly. Once verified, those payments are posted in sequence to the correct patient account ledger. And I can't stress this enough, you absolutely must maintain a rigorous, date-stamped daily file of all these documents. If you ever face an audit or a dispute, having a meticulously organized file linked to the exact EOB receipt date is your absolute best defense. Honestly, modern offices only survive this sheer volume of claims by leaning heavily on their practice management software. If you take the time up front to preload your specific payer contracts, the software does the heavy lifting for you. An ERA comes in and boom, the program instantly connects the procedure code to the expected payment. It automatically flags any math that dares to misalign with what your contract actually dictates. It's a total game changer. But what happens when the math just doesn't add up? What if a claim is unexpectedly denied, or the allowable amount comes back way lower than your preloaded contract says it should be? That takes us into Section 5, resolving discrepancies and billing, managing the leftovers. During the posting process, you're essentially putting on an auditor's hat, hunting for discrepancies. You have to ask yourself, did the payer wrongly deny a procedure due to an incorrect unbundling assumption? Did a third-party administrator just completely botch the pricing? Or maybe you're dealing with a silent PPO applying unauthorized out-of-network discounts. And crucially, you have to keep an eye out for overpayments too. If a payer pays you too much, refund it immediately. If you don't, they will eventually find out and they'll hit you with interest charges. When you do inevitably find a discrepancy, like an underpayment, your first line of defense is what's called a first-level appeal. Honestly, this is usually just a formal reminder to the payer that their software missed a specific contract rule or maybe a negotiated carve-out. To do this, you just package up the EOB, a copy of the original claim, and the supporting medical records, and you submit the whole shebang to request reprocessing based on your actually agreed-upon pricing. Okay, so the very last step in this entire revenue cycle is finally billing the patient. But notice the sequence. Only after the claim is fully adjudicated, the ERA is posted, any of those disputes or appeals are completely resolved, and all the contractual write-offs are accurately applied to the ledger, only then can you route the verified remaining balance to the patient. I really want to emphasize this because it's a strictly regulated point. You must honor your provider-payer contracts. You can never, ever pass a contractual write-off loss onto a patient's bill just to make up for a discount you gave the insurance company. It doesn't work like that. Patient billing must only reflect their genuine copays, deductibles, or legitimate non-covered services. Understanding this chronological journey really transforms you from just a data entry clerk into a fierce, knowledgeable advocate for your practice. Master these steps, and you're protecting both your provider's revenue and your patient's trust. But ask yourself, are your current software setups catching every single silent discount those payers try to slip past you? Give it some thought. Please like, share, and subscribe to Decode Healthcare with Arshal.